Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's look at a specific scenario. All right, I've got, okay, I'm going to bring up the exchange rate first. So I'm bringing up the dollar yen. And, the dollar yen has been interesting. We've had this weird little consolidation. We had prices come all the way from about 93.50 all the way down to 87.50 or so. And then this is yen to the dollar, by the way. You'll notice if you're not a Forex trader, when the dollar switches sides, so we were looking at the euro to the dollar, so things were priced in dollars. So how many dollars did it cost to buy a euro? Because the dollar's on the other side of this equation, this is how many yen does it cost to buy a dollar. And in this case, the index is priced and looks very much like the like what you'd see in a spot chart. So 92.79 right now. That the way you could equate this is you could say, okay, so it costs about 93 yen to buy a dollar right now, which is about right. And you'll notice that in this little consolidation we've been stuck in, we're kind of creeping up on that 93.50. In fact, prices might get up here to about 93. We might be looking at the potential for a correction. We had a really big day to the upside on the 24th, and if prices got to that level and then began to peel off and go down, I know there's a lot of Forex traders out there who might be shorting the market at that point to try to make some profits. And if they got a fairly, maybe an intermediate time horizon, maybe they're looking out 60 days or so for the move to complete, they could be forecasting all the way down to, prices getting all the way down to near-term support at about 88.50. We've been here several times. You'll notice that right down along that corridor, we've been here 1, 2, 3, 4, 5 times already. We broke through once. So 5 out of 6, we've stopped at about 88.50. So, that makes for a reasonable price target or pretty close to it. So let's think about this. What, if we were to construct a trade that, let's say we think this move could happen, if we get a confirmation and prices start to bounce off of this, we think this move could complete, if not in April, then by May. All right? We could do one of two things. So let's contrast this. I'm going to go back to my spreadsheet. And now in this case, we're controlling 10,000 units of the base currency, so it would be in dollars in this case. Let's say we've got leverage of 100 to 1, which right now that's I'd say pretty average, kind of on the low end of average. I see a lot of leverage rates, especially with overseas dealers, that may be a lot higher than that. But let's keep it at 100 to 1 for now, and that's kind of traditional. So we'd have to post $100 worth of margin to take advantage of that, and per pip move, we're going to get about $1. Now, when you're trading the dollar yen, it doesn't equal exactly $1, but it's darn close, so it's going to be close enough. And we think that the downside potential here, if we shorted it, maybe 1,000 pips again, so getting all the way down into that 83 range, 83 to 85 range. And so we got 1,000 pips to go to the downside. By contrast, so I priced this option, the 93 option, so a little bit in the money, but if we assume that index prices got all the way to 93, they're beginning to bounce off and they're at 93. An option that expires the third Friday in May, as I quoted it, was $160 on the yen for a put. 93 strike price, and let's say the market moves by 1,000 pips, so that's going to be $1,000 return. So that's going to be an option contract that's now worth $1,000. So now all of a sudden we can make some real comparisons, and we can start to say, well, all right, now let's start to assume what happens, what's my own personal trading history with the dollar yen when I take on a position like this? how big of a stop loss do I have to use? And if I use a tight one, how many times do I get stopped out in order to take advantage of a move by the time it does take off? So we can start to equate apples to apples here and begin to think about, well, all right, so is it really worth the potential risk and, headaches and waking up and finding out that you got stopped out in the middle of the night, and then in the morning, during the London session, everything started going your way, but in the meantime, it's too late for you because you got stopped out. So we start to price in and discount a little bit our Forex trade to try to say, well, okay, what's realistic? Out of X number of trades that ultimately did go my way, how many of those might I have not been able to take advantage? Half? A third? 60%? It's probably only a question that you can answer, but sit down and think about it. How many times do I wake up to find that I got stopped out on a price spike, and then ultimately the market recovered during London or the New York session, and the market it wound up going the direction that I knew it was going to go, but because I had that risk control in play, which is appropriate, I had to get out of the trade. So then all of a sudden we start to see that, oh, okay, so if I am theoretically giving up a little bit of this leverage when I compare the option to the spot position, maybe I'm giving up a little bit of that, theoretical advantage. But am I getting another advantage on top of that? And this is basically how we contrast it. So this would be what I would be thinking about as I walk through what are the alternatives and what could I be looking at, and can I try to make an apples to apples or as close to an apples to apples comparison of the differences between leverage and how those differences may be offset by some of the benefits of a currency options position versus a spot position. Okay, so like I said, so I'm going to pause here and turn it over to Q&A. I'm going to share my charts again in case I get questions about that. So Dave, so I see a couple of questions already. So let me. So I got some people who are disagreeing with me, and I think that's fine. I suspect that what leverage does to a Forex trader, and how leverage increases risk, the two are definitely tied together. So the more leverage goes, the more risk is. So the risk of a loss is pretty extreme as leverage gets more and more extreme, especially as that leverage gets maxed out. So Dave, I recognize that risking 700 pips on a 1,000 pip trade is a mistake. I was using it as kind of an extreme example. So just to disclaim that a little bit. Okay, does anybody else have any questions? And one of the things, I would say one of the takeaways here is, for those of you who look at, the contrast that I'm pointing out between leverage in the Forex versus leverage in the options market, whether you agree or not agree with the way that I would look at, the benefit or potential risk of a stop loss whipping you out of a trade, you can disagree with that, and that's totally fine. There are a lot of ways to look at the Forex market and about risk control in the Forex market. I would separate that particular side of the argument with the advantages of a Forex option. That in fact a currency option, depending on the situation, may be viable in a situation that the market might be a little bit too volatile to take an underlying spot position. So they really are kind of two concepts. And so you don't have to agree with both in order to see where an option position with the ability to stay in a position for the long term is maybe an advantage.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.